Thank you, everyone, and good afternoon. Welcome to Salasar Techno Engineering Limited's earnings conference call for the fourth quarter and the full year ended 31st March 2019. I would like to begin by expressing my gratitude to all of you for taking this time to join us today. On the call with me is Mr. Pramod Kala, the Chief Financial Officer of the company, and the Bridge IR, our investor relations team. Before we get into the financial and business performance for the quarter and the full year ended 31st March 2019, I would like to start by giving you a short overview about the company. Our journey began in 2006 as a telecom tower manufacturer, and over the years, we have successfully diversified our business into other verticals, expanding our operations in various parts of India. Since inception, we have supplied more than 25,000 telecom towers of various designs to all leading telecom players, and we share a very good business relationship with each one of them. Our technical collaboration with Rambol, a Danish company, has enabled us to emerge as one of the key players in manufacturing and fabrication of telecom towers. This collaboration has helped us provide our customers with better designs and less bulky towers. We are a preferred telecom vendor and tower suppliers today for all major telecom companies and enjoy a sizable share of the market. Our total installed capacity today stands at 100,000 metric tons per annum, and our offerings include steel fabrication and infrastructure solutions for telecom towers, transmission line towers, substation structures, solar module mounting structures. We also manufacture and provide utility poles to our customers for different uses, such as high mast poles, smart city poles, stadium lighting poles, flag masts, and other lighting poles. We are also an approved vendor for Power Grid Corporation of India Limited. Primarily, our business can be classified into four verticals. Number one is telecom towers. Number two is transmission, which can further be divided into EPC projects, turnkey projects, railway track electrification, and supply of their structures to other contractors for the similar projects. Number three is solar module mounting structures. Number four is poles, which includes high mast poles, smart city poles, lighting poles, and other utility poles. We are also an approved vendor for Central Organization for Railway Electrification, that is CORE, to supply track electrification structures to other EPC contractors. Our company is gearing up to sharpen its focus on railway electrification and intends to increase bidding for such projects. We have already started building capacities and training our manpower to handle all railway-related projects. The sector continues to witness uptick in both orders and execution, and we expect growth to remain strong and gain further pace with increased participation opportunities. We have constantly innovated to provide efficient solutions. Our excellent execution capabilities have helped us gain the trust of our clients, which is quite evident from our strong repeat orders from all our clients. Also, I'm happy to share that during the year, the Salasar has been bestowed upon with two of the highest accolades at Indus Towers annual partner meet held at Gurgaon. The Gold Award, which is the top award among the category of towers, and we have been given that top award in the infrastructure sector. And the Platinum Award, which is the Partner of the Year 2018-19, which is the highest and the most coveted award that Indus bestows upon any partner among fraternity of almost 400 partner partners across all product categories. So that's a matter of proud of us. These awards be a testimony to our company's determination to provide the best services to its customers. Customer satisfaction has been and is our first and foremost goal. This year again, we continue to remain committed to meet our target of zero defects, always on-time delivery and timely project execution at sites and in most ethical business practices. Just to bring you about a little knowledge about Indus Towers. Indus Towers is one of the largest tower company, having 136,000 towers on ground, and which is the largest company in terms of tower holding outside China. Coming to the consolidated financials for the quarter and the full year ended 31st March 2019. These numbers are in line with India accounting standards, that is in AS guidelines. Financial highlights for the fourth quarter. Focus has always been on improving overall business, which can be seen in our performance. The company registered revenue of 187.6 crores with a year-on-year growth of 28% from rupees 147 crores in the same quarter last year. The growth has been driven by a combination of increase in execution of orders and higher volumes. The EBITDA was at 23.3 crores for quarter 4 FY19, an increase of 45% as compared to over rupees 16 crores in Q4 FY18, and was mainly driven by higher end revenue and better utilization of resources. The EBITDA margin increased by 150 BPS in quarter 4 FY19 at 12.41% as compared to 10.91% in Q4 FY18. Profit after tax was at rupees 10.2 crores in this quarter as compared to 9.5 crores in quarter FY18, a growth of about 6.5%. Quarter 4 FY19 basic EPS stood at rupees 7.66. Coming to the financial highlights for the full year FY19. FY19 revenue stood at 654.9 crores with a year-on-year growth of 32.4% compared to rupees 494.7 crores in FY18. The growth has been on account of timely execution of orders across all segments and also from supply infrastructure for railway electrification that was started within this financial year. Our EBITDA stood at rupees 73.4 crores, representing a growth of 35.8% compared to rupees 54 crores in FY18. The increase is on account of operational efficiencies and higher capacity utilization. Our EBITDA margins in FY19 was at 11.2% against 10.92% in FY18, an increase of 28 basis points. The profit after tax was rupees 33.3 crores versus rupees 29.6 crores in FY18, representing a growth of 12.3%. Overall, we see good demand in the industry and our focus remains on increasing our market share and providing quality product and services to our clients. With a very competent team in place, we are confident of achieving these milestones we have set for ourselves. Basically, this is all from our side now, and I would like to once again thank you everyone for your time and attention. We are ready to take questions now.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ankit Merchant from SNC Global Securities. Please go ahead.
Hello, sir. Good afternoon and congratulations for a good set of numbers. So a few questions. One is related to your order book. Can you shed some light on the order book? Second is, how is the current debt? And third question is related to your working capital. Can you shed some light on the working capital also? Thank you.
Okay. So the order book, the pending order book for EPC at the moment is 250 crores, which is for the projects which are running, which are in the execution mode. And we also have about 110 crores of orders wherein we are L1 and we will get the purchase orders or the authority letters in some time. Other than that, for the manufacturing order book, we have about 90 crores of orders pending from Reliance. And other than Reliance, we have some 20 crores orders from other customers, which we have confirmed in hand. And as you know, the tower industry, the orders other than Reliance come on a monthly basis, on a very periodical basis. So which is bound to repeat, every month. So confirmed orders in hand, if you say, we have some 250 crores which is being executed on EPC, about 110 crores wherein we are L1 and we are likely to get the orders in few days or couple of weeks time, and about 110 crores of manufacturing order from Reliance and other telecom operators and some other poles and lighting masts. As far as the debt is concerned,
no debt, only working capital.
It's a working capital debt of 140 crores. As such, we have never had any long-term debt. So as on 31st March, we had 140 crores of working capital limits with the bank from SBI and HDFC.
Sure. Sir, then for the year coming for FY20, then what would be our top line target which you could be looking at then?
See, our internal target is, we will try and grow by at least 15 to 20%. See, there is every chance that we might grow even beyond this, but this is something minimum we would like to achieve. Considering that there is a stable government at the center, and the focus of the government is going to be infrastructure in the coming years. And we are expecting a lot of projects and spending happening in the coming months and the coming years. So 15 to 20% is something which is the minimum we would like to achieve. It could be even more.
Sure. And which segment will grow faster? Will it be the telecom segment or will it be the APC segment?
See, we are limiting ourselves in EPC to about 20 to 25% of our total turnover for the simple reason that the working capital cycle becomes a little longer. So the growth would come partly from telecom and some growth, I'm expecting more growth in terms of percentage coming from railways, wherein we'll be supplying a lot of structures to our own projects in railways plus to other contractors like L&T and Tata Projects and Kalsaru and other companies who are doing railway electrification projects. So this year, actually, we started railway only in this financial year, the supply of structures, and we have done about 50 crores of sales in this year, which I'm expecting to almost double in the coming year.
Sure.
Yeah.
Are we expecting a soft year?
Sorry? Hello?
Sorry to interrupt, Mr. Merchant. Your voice is breaking up.
Yeah. Is it clear? Hello?
Yeah.
Hello, Mr. Merchant.
Hello?
Excuse me, sir, your voice is breaking up.
Okay, I joined the queue. I'll join by this.
Ladies and gentlemen, the current participant has gone off the queue. Participants, if you wish to ask a question, you may please press star and 1. A reminder to the participants, anyone wishing to ask a question may please press star and 1. Participants, if you wish to ask a question, you may please press star and 1. The next question is from the line of Jehant Bala from Nirmal Bang Securities. Please go ahead.
Hello, sir. Sir, my question is on railway electrification. I think according to government targets, over next 3 years, the entire electrification process will be done. So, I mean, in terms of opportunity size, isn't that like what happens after that? I mean, so within railways, what is our strategy to grow? I mean, what if this gets exhausted over next 3 years?
See, 3 years is still a long time. By the time, I don't really think that, the amount of work which is to be done in the railways can be done in 3 years, Even today, I think more than 40% of the railway tracks are not electrified. They are running on diesel, right? So I really doubt if it can be achieved in 3 years. I mean, in fact, India doesn't have so much of resources that if we put together everything and we are able to complete that, within 3 years.
Okay.
I'm not sure where this coming from. How do you say that is going to be completed in 3 years? I'm not sure if I haven't.
So there is actually a document prepared by CRISIL which says that by 2022 that is the plan as of now. So but obviously government delays will be there. Sir, secondly, any other areas that we are eyeing beyond what you discussed in your opening remarks for growth or entering any new segments?
See, we are there in mostly every sector, wherein fabricated or galvanized structures can be used, except for the crash barriers business, which is like on the highways, side guards, you see. Except for that business, we are almost there in every segment. And that segment in particular has a lower EBITDA margin. So we have restricted ourselves to not get into that. We might get into that if we have, some extra capacity available. As of now, we have whatever capacity we have, we are trying and, optimizing it for the existing sectors only.
Okay.
So we will try and concentrate on the existing sectors wherever we are working in at the moment.
Okay. And sir, for this quarter particularly, the EBITDA margins were pretty high. So any particular reason?
See, always what happens in Q4, there's always a manufacturing pressure because the customer has its own targets to achieve, and they push us to manufacture more and dispatch more. So if you see, there has been
basically operating leverage.
Yes, operating leverages and the operational efficiencies. Plus, we also got some advantage for some raw material prices during the fall in February.
So nothing to do with the product mix change or?
No, nothing as such. No, it's basically mainly because of operational efficiencies.
Right. Okay. And sir, on telecom front, sir, if you can throw some light, can this telecom revenues continue to grow at 20% for next 2-3 years? And just some color if you can provide.
See, telecom is one of the most unpredictable industries, in the sense that you never know what's going to happen tomorrow. But if you go by the numbers which are being projected by the industry, we might grow even more than 20% in telecom. Because there is a huge opportunity in terms of 5G, which is knocking on our doors in early 2020 or later this year, which will require many structures, not particularly towers as such, but there will be many other structures, maybe lighter structures, if we really want to cover the whole country. It all depends how the government allocates the spectrum for 5G and how the operators and the tower cos decide to spend on 5G rollouts. The opportunity is huge, it's big. It all depends on the government policies, how it is going to, how fast and how soon they want it to be rolled out all over the country. Even today, the 4G is not connectable in many parts of the country. I mean, you go 200 kilometers out of the city center and you are out of 4G as such. So even in 4G, there's a lot of coverage has to be done, a lot of structures have to be put up, a lot of monopoles have to be put up. Similarly, 5G presents a huge opportunity. But all said and done, it's always a very unpredictable industry. We have, in fact, unpredictable in the sense that we have actually grown more than what we had expected, not the other way around.
Okay.
Yeah.
And sir, what if the 5G deployment takes time, regarding spectrums? Is there space enough in 4G to grow for next 2-3 years?
Oh yes, of course.
Okay, fine, sir. Thank you.
Yeah.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is from the line of Ashutosh Garud from Abundant Wealth. Please go ahead.
Hello.
Hello, Ashutosh.
Yeah, hi. So can you give me the order book number once again? I just missed it.
See, order book, the one which is under execution for EPC is about 250 crores. And we have 110 crores of L1 confirmations, wherein we are L1 for 110 crores, wherein we are going to get the confirmations and orders in next maybe a couple of weeks or 3 weeks. And other than that, from manufacturing side, we have about 110 crores, 10 crores of orders confirmed in our hand.
So on a confirmed level, it is basically 360 crores without the
360 crores of EPC. And
L1 without the L1, I am saying.
Yeah, without the L1, of course. Yeah.
360 crores. Okay.
Yeah.
So what was the same number last year? Same quarter?
I won't remember that, but it should have been somewhere in the range of about 300 crores. I'm not sure about that. I don't remember that number.
And
now.
on Q1Q, let's say Q3 FY19?
I won't have that figures readily available in front of me, but that can be sent to you.
Okay. Sir, and just wanted to understand that we have seen a couple of soft quarters from in September ended and December ended. If you see on top line front, those were soft. So, is this Q4 results as a result of delayed execution, which has come together in Q4, or
partly yes.
Okay. So, and how do you see the next year going into FY20? Do you think that it would be because as you mentioned, apart from maybe Reliance, not many are going on for this telecom expansion per se?
No, I never said that. Everyone is going into expansion. Okay. Reliance is, of course, the major force. But when, just remember one thing, when one telco or one operator is spending on the infrastructure, the others cannot, be behind.
Okay.
They have to match up. See, the scenario today is that there are going to be only 4 operators in this country. One is Vodafone Idea, one is Airtel, Reliance is third, and the fourth is BSNL. So it is like for them to, cover the whole country and get the maximum benefit out of it. So they have to have the best infrastructure. Vodafone Idea, which was not spending last year because of their merger procedures going on, they have already started making inquiries now for their further expansion.
So what kind of growth on total order book and total revenue front are you looking at next year for the next year?
See, we are eyeing a minimum of 15 to 20%. It could be even more. It all depends how telecom sector unfolds and how railway sector unfolds, how this government is, focused and how soon they want the infrastructure sector to grow. That will also play a major part. Like we are doing in railways, we are trying to double our capacity and we are trying to double our revenue from railway sector this year compared to last year. But, if there is a pressure from the government and pressure from the other EPC contractors to produce more, probably we could even, more than double it.
And how much of this 360 crore order book is from telecom?
110 crores.
And sir, on the working capital front, how do you see that panning out going ahead? Because last 3-4 quarters we have seen this working capital interest cost piling up on the P&L, and eating into your PAT growth. So how do you see this shaping going ahead, and how much of it was this? Was there anything to be linked with the NBFC crisis or any liquidity of fund liquidity?
No, we have got nothing to do with the NBFC's crisis or anything. See, the simple math is that from 497 crores we have grown to 650 crores, right? That's almost 32%, correct? And the interest outgo is 6.46 crore versus 10.35 crores. This year we have paid interest to the bank at about 10.35 crores, whereas last year it was 6.46 crores. Okay. Last year the borrowings were 104 crores. This year is 145 crores. And the bank charges actually increased from 63 lakhs to 2.47 crores because of PG and LC charges. So that has been the major contributor to the increase in finance costs. Plus, we must also understand here that last year when the IPO came, we had that IPO money lying in our account for some time, so that the interest cost paid to the bank was much less compared to this year.
Okay.
So, I mean, if you see percentage-wise, the finance cost of versus the turnover compared to our peer group, probably we are in one of the best situations.
So do you mean to say this 5 crore kind of a run rate will continue? If this
5 crore per quarter, you mean?
Quarterly run rate of interest cost should more or less, come down from there.
Yes.
Okay, sir. Thank you.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is on the line of Baidik Sarkar from Unifi Capital. Please go ahead.
Hi, good morning, Shashank. Sorry, I joined the call a tad late. I'm just trying to understand, just an extension of the question from the previous caller. Now, considering the improvement in revenue traction you're guiding for, which is 15 to 20%, and considering the fact that you will have some internal accruals in this period, are you saying that your cash flow projection waterfall is still 5 crores in interest costs over the next 4 quarters, or will that go up in conjunction with this 15 to 20% revenue growth that you're talking about?
I think it should rather reduce. I mean, 5 crores is something which is the highest cap we are putting into it.
Okay.
I mean, there's no reason that should go up.
Okay, so probably we're at peak finance costs as we speak.
I mean, of course, the finance costs would increase in the ratio of our top line increase, probably.
No, so that's what, I'm trying to clarify on the absolute amount of it. Obviously there will be internal accruals and, you plan to grow at 20%. So from an absolute perspective, I think, what your CEO for just quipped was, it will drop from an absolute perspective.
Yeah, probably, yes.
No, I mean, if you want to take a minute and reflect and answer, that's perfectly okay. But, that was important to answer that. Okay, and in terms of your order book that you mentioned, you said 250 crores from EPC and 110 crores in manufacturing. By manufacturing, did you mean railways or for telecom or both put together?
It is mainly telecom and railways.
Okay, so manufacturing 110. Okay. So over the last quarter, what was your telecom revenues per se, and for the entire year, what was your telecom revenues?
Telecom revenues have been, I think, close to around 60%. Just a minute. I have those figures.
Absolute number, yeah.
Absolute numbers. Railways. Just a minute. I think railways was close to 50 crores.
Railways was
Telecom 397.
Telecom was 397 crores.
Telecom was 397. And what was the previous year's figure for telecom in FY18?
FY18 telecom would have been 265 crores.
265. Okay, so obviously, that's a good growth, 50%. Is there a risk of, again, taking on from the previous callers, what's the best case growth scenario in telecom is concerned? I understand you have a quarterly offtake and your visibility reduced to just a quarter, but where would you peg an absolute number for telecom in this quarter?
In this quarter? In this particular quarter?
No, for this year, 20.
See, I think not less than 400 crores. I mean, of course, we have. You would say that you've already done 397 crores, so 400 crores is something which is nothing. You're giving guidance, but I think It could be anything between 400 to 450 crores.
Okay. So which is almost a flattish outlook.
Yeah, on a telecom, yes, because we are almost at, in terms of telecom, we are there almost at I would say maybe 75-80% of the capacity. Though we have added some new products to our kitty, and that might give us some extra revenue of some 20, 25, 30 crores this year. But I think it should be anything between 400 to 450 crores.
Okay, so railways is 50, telecom is 397, and the other segment would be which ones?
See, let's say railways 450 crores. No, you're talking about the current number or the guidance?
Current, both. If you could just give the current number first, and then we'll talk about
current number for railway, for the telecom was 397. Railway was 50 crores, right? And others, which include transmission line towers and everything else, which includes the poles and everything. So it's about 90 crores or something.
Sorry, I just missed that number. Just transmission lines and everything was how much?
About 90 crores.
90 crores. Okay, so that adds to 537. Okay. Is there any other segment? I think there is some other segment, right?
No, I mean that includes almost everything.
Okay, so this adds up to what?
That transmission includes the poles also, the transmission line poles and the lighting poles also.
Okay.
So some 540 crores odd
is from the
manufacturing. Yeah.
540. And where would you peg railways and transmission next year? 20?
Railways from 50 to anything between 90 to 100 crores.
Okay.
And telecom anything between 400 to 450 crores.
Okay.
And probably this 90 could go. See, basically this 90 crores is part of the supplies which we supply to our own EPC projects.
Okay.
The manufacturing. Here we're talking about the manufacturing only. So it could be again an increase of 10 to 15%, maybe 100 to 120 crores.
Okay, so because your consolidated revenues for this year is about 654 crores. So I think in your previous year's numbers we still are missing some segment. What you've given adds up to just 540 crores.
Yeah, so 113 crore was from the services.
Services.
Yeah, that includes the EPC services, the tower installation services, and bought out items which we buy from. You can include that trading numbers. The trading items which we buy from outside. To complete the EPC projects.
Sure, I'm sorry for confusion. So the transmission number, what's the best case you said that will go to?
In terms of manufacturing?
Yeah, in terms of manufacturing.
Anything between 100 to 120 crores.
Okay, and the EPC number?
EPC number would be something around 150 crores, the services number.
Sorry?
150 crores.
150, okay. Okay, right. And in terms of pricing, do you have any operating levers to improve on your pricing, or would you recommend that the blended average for 19 is the best possible scenario for 20? And is there a risk to that margin?
See, as such, there will not be a risk to the margins overall, but the pricing scenario would depend upon the raw material prices, right? In telecom especially, because the prices are revised every month or every quarter. So if the raw material prices go up, probably they'll be revised upwards, otherwise the other way around. But in case of transmission EPC projects, we have fixed prices there. So there will not be much of a difference there.
Okay, and CAPEX guidance for this year?
We haven't planned any CAPEX for this year at least.
Okay, and the blended tax rate should be equal to what we've seen last year?
More or less, yes.
Okay, thank you very much. I'll be in touch.
Yeah, sure. Thank you very much.
Thank you. The next question is from the line of Kalpesh Koti from Valentis Advisors Private Limited. Please go ahead.
Yeah, good afternoon, sir.
Yeah, good afternoon, Kalpesh.
Sir, last Concall you said about, there is some payment issue in the EPC contract. That's why we have slowed down our EPC execution. So what's the current status? And the second
it's better
question,
now. We have recovered quite a bit. And see, the reason that we are limiting ourselves to about 20% in EPC of the total top line is because that we don't want to increase much on the working capital cycle, right?
Right.
And being government projects, the cycles are sometimes, the working capital cycles are sometimes very unpredictable, sometimes related to political decisions and things like that. But now, very stable government being at the center, and so I think the things are going to improve. And as such, the projects we are doing, we are now more or less comfortable in terms of our payments. As such, there's nothing that we feel that is stuck. As such.
But if you see that your data is still high.
Yes.
So do you expect for the next year the data will remain at the same level?
See, maybe a few days here or there, we are focusing on reducing the debtors, but somehow this year we have not been able to. But of course, the focus is to reduce the debtors and to collect as much as money possible from the EPC projects.
Okay. So what was the capex figure for this year?
We have not done any capex, nothing significant.
No. For FY19, what was the capex?
No, there was no capex.
There was no capex.
Hey, just a minute. The Hassan, maybe couple of crores.
Across 10 crores.
10 crores?
So that was the maintenance capex?
Yeah, it's some addition of cranes and some extra, machinery for the routine extra production. Maybe improving infrastructure.
Right. So what's your take on the telecom segment? And, for the past 6 months, you were expecting the order inflow from telecom will going to come in FY20 also. So I think, what's the current order book from Jio?
Jio, we have pending order of about 90 crores to be executed. And, and from others, we have around 20 crores, plus we have orders from railways. Telecom as such looks quite positive to me. I mean, I've been always bullish on telecom. I mean, though some people have countered it by saying that the growth might not be there. But we have continuously grown in telecom sector, and even today I feel the same. I'm still very bullish on telecom, especially the way we are placed in with the customers. We are in a very good position, wherein we are probably today we are the only company which is present in every kind of a structure which is required for a telecom site. It could be a tubular tower or an angular tower or a smart pole or a monopole or a slip joint pole or a flange joint monopole or a ground-based monopole or a smart pole or a rooftop pole or a cell on wheels, complete solution for any telecom company. So I'm still very bullish, in fact, rather we have, this year only we have, in FY20 we have started a new product which is cell on wheels, and which is a good product, and it's been, being taken by the customers very well. It's been received by the customers very well.
Okay, so what's your telecom growth expectation for FY20?
As I said, anything between 10 to 20%.
But it's still, if you compare with the historical growth, it's less. See,
the base today is about 400 crores, right?
Right.
The earlier base was 250 crores.
Okay. So, are we expecting any order from Vodafone?
Yes, we are in talks with them. See, what has happened is Vodafone Idea, they do only very little work on their own. they basically are operators. So they are not putting many towers on their own. They give it to either Indus Towers or American Towers or, Tower Vision, so, or Bharti Infratel. So, and these are basically tower cos are the ones who are putting more towers than the operators. Operators are putting very specialized kind of small poles in some areas. So the volume coming directly from Idea Vodafone is not much. It could be a very small quantity. But of course, indirectly they are customers because they are leasing sites from Bharti Infratel or Indus Towers, whom we are supplying towers to.
Okay. And sir, how's your first 2 months of FY20?
Mm-hmm.
Do we expect slowdown because of the
election? No. Because of elections, no. We have had a decent run for 2 months. And, of course, there's some billing to be done for the EPC. But otherwise, manufacturing-wise, we are pretty decent.
And how the raw material price moved up?
Raw material prices are more or less constant for last couple of months or rather 3 months. So not much of a change.
Okay. Thank you, sir.
Yeah. Thank you.
Thank you. The next question is from the line of Apurva Mehta from AM Investments. Please go ahead.
Hi, sir. Congrats on good set of numbers.
Thank you, Apurva.
So, sir, I just wanted to ask, sir, we, in telecom side, we are at 400 crores. Railways was 50, transmission was 97, and EPC was, services and EPC was 130. I'm right?
Sorry, your voice is somehow not very clear and it's echoing. So I'm not able to understand the question.
Just a second.
Yeah.
Hello, is it okay, sir?
Slightly better, yes.
Sir, So, EPC, what we are seeing, we have an order book of 250 crores.
Yeah.
Hello?
Yeah.
We have an EPC of 250 crores and we have a transmission order book of, 110 crores something, L1 which we have. So that is 250 crores will be executed in this year, or how do you see that?
No, see, basically this 250 crores is going to be completed in next 18 to 20 months.
Okay.
Yeah.
Okay. And sir, we had one, huge debt, which, debtors which was there of close to, 70, 80 crores of, 100 crores of debt coming from a single client.
Yeah.
So how is that, where is there, we are, likely to get to, in next few months. So how?
See, that project is going to get over in next 2 to 3 months. Wherein we have to do a billing of about 40 crores or more, right? And we have been able to recover some amount, good amount of money in March. And I think all the PVNL amount should be recovered in next 6 months, once we complete the order. Yeah.
Okay.
It's not a problem as such. It's just that it's been dragged.
So next year, if we, what you are telling is 450 crores from telecom, and railways will contribute how much, sir?
Sorry, 450 crores from telecom?
And railways would contribute how much, sir?
See, telecom would be anything between 400 to 450 crores, and railway should be anything between 90 to 100 crores. 90 to 100 crores. Okay.
And EPC and others will be others. That would be
EPC would be close to 150 crores. Anything between 140 to 150 crores, yeah.
Okay. So roughly if we see the current run rate of, 187 crores of turnover, which we rate 12% margin, that will be the run rate for next 3 quarters also, because if you want to reach... if you want to, because see, if you are telling that, operational scale is there, that's why we had a better 12% margin.
Every quarter is not the same. See, every quarter is not the same. Okay.
Yeah.
See, every quarter is not the same. This quarter we have had a good run because, always the Q4 is the best quarter in terms of dispatches, in terms of, the operational efficiencies. But of course, I'm not guiding you for the quarter-wise. But of course, we have been guiding you for about 11% EBITDA overall year-on-year basis, which we have achieved, right? So we'll keep on growing. We'll keep on, trying to deliver as best as possible.
Okay.
But it will not be right for me to comment on the future EBITDA margins.
Yeah. But normally what is there, sir, telecom is always a lower margin business where we would like to grow a little slower this year, which our guidance is a little slower, where we are guiding only 10% growth. Right. And others which would be growing much faster where the EBITDA margins are better than telecom. That is our understanding.
The reason for growth is not only the margin, it is also the opportunity available. Right?
Yeah.
In railways, the opportunity available is much bigger compared to the telecom because telecom is already, we are on a 400 crore base. Right? Where in telecom, in railways, we are only at a 50 crore base.
Okay.
So, to double, if you say that I have to double my telecom business, will be almost impossible to achieve.
Yeah.
To double this probably still. Hello?
Yeah.
The base in telecom is higher, is much bigger compared to the base in railways.
Mm-hmm.
It will be,
So, my point was that if we grow a little slower in telecom, means maybe 10% of that, our margin should improve because other business will have a better margin.
See, overall, the margins in telecom are, it also vary from customer to customer.
Yeah.
And it's a mix of margins. So, of course, sometimes railways have better margins, sometimes telecom have better margins. It all depends.
Okay. Yeah. Okay. And sir, the debt, this 140 crore debt will be our peak debt for next year?
No, I think there will
be... If we recover money from the, where we have money stock of more than 100 crores of 70 or 80 crores, whatever we had spoken last time. This will be...
So the utilization should be in the similar range, but we will try and keep a cushion with the banks that, we take some little extra available limits with them. But we'll try and keep the debt as minimum as possible. But, if we are increasing our turnover by 15 to 20%, probably the utilization at some point in time might also increase a bit. May peak up a few days and then, it can come back again.
Okay.
145, anything between 150 to 160 crores should be something which should be reasonable.
Okay, thanks a lot and sir, wish you all the best. Yeah.
Thank you.
Thank you. The next question is from the line of Ashutosh Garud from Avendus Wealth. Please go ahead.
Hello.
Yes, Ashutosh.
Yeah, hi. So just wanted to understand when you're talking about this 5 crore interest cost in line with your growth in the revenue and IPO funds not being available and working capital going up. So it would be safe to assume if we grow on 15-20% in future, this will be in this interest cost will also increase in the similar kind of proportion, right?
See, this year it is not 5 crores. Like the total finance cost this year is about 16.5 crores. Correct?
Yeah.
Right. Yeah. Only the fourth quarter is something which is 5 crores.
Yes.
And wherein we have achieved a turnover 187 crores.
Yes.
Right. So yeah, if we are doing a turnover of 750 to 760 crores, probably 20 crores is the maximum finance cost which we will incur.
Okay. Because if you see in the last quarter also, let's say we did like around 150 crore kind of a top line, and we were almost touching 5 crores as an interest cost in Q3 also, 4.8 crores.
Because there were a lot of bank charges other than the interest cost, wherein we had to get the BGs and LCs issued for the projects, which we have tendered.
Okay. Thanks.
Yeah, thank you.
Thank you. Ladies and gentlemen, that's the last question. I now hand the conference over to Mr. Shashank Agarwal for his closing comments. Mr. Agarwal? Hello?
Can you hear me?
Yes, sir, we are able to hear you. Please go ahead.
I would like to thank everyone once again for joining the call.
I'm so sorry, sir, but your voice is breaking up.
No?
No, sir, still
I
not
think
able to hear you.
Hello?
Sir, we are not able to hear you.
Hello?
Yes, sir, please proceed.
And you can hope that.
Thank you.